is your exit strategy for the Quant Fund designed? Do you review it on a daily, weekly, or a monthly or a quarterly basis? Can you please explain that part?
Sure. So we look at it roughly on a quarterly basis. Sometimes it could be even a 6 monthly basis, but roughly more often it's on a quarterly basis. Now, the same principle, which is that you want to buy within the top 75 of various fund houses, quality, momentum, weighted on low volatility, we arrive at the new signal. So let's say that we've got an existing set of 40 stocks with a particular weighing schema, and then in 3 months we know, or we run this again and we get a new set of 40 stocks. Okay. Now, how do we blend both of them? What stocks to get out of it and what stocks to get in from the middle? Our thinking has been that we should always get some freshness in form in terms of the new team. So what we want is, from these set of stocks, we take 20% of stocks. So if there are 40 stocks, then we take about 8 stocks. They should always be part of the new team, so that there is always some freshness in form that we are trying to carry it for the next season, right? Now coming to these set of 40 names. Now see, this 3 month or 6 month is an arbitrary time, right? No company or no stock necessarily has to perform every 3 months, every 6 months. Different stocks take different periods of time to get appreciated by markets. All we are saying is that if there were 200 stocks at that point of time, the median stock performance is the 100th stock. As long as any of our existing stocks is at least close to our median stock performance, we think they are doing a reasonable job. The moment they start dragging down from the median stock performance, that is when we get out. So the way we look at it is we break down these performance of the 200 stocks into quintiles: Q1, Q2, Q3, Q4, Q5 in 40s, groups of 40s. As long as the existing set of stocks are within Q1, Q2, Q3, we think they are reasonably doing okay. They don't have to be the best performing player in every match, okay? But as long as they are not consuming too many balls and not scoring, and therefore start impacting the overall averages for the team, which is when they start moving in Q4, Q5, that is the only time when we tell them to get out. Okay. And we tell them that, okay, you again play back in Ranji Trophy or the next IPL, etc. We'll keep looking at your form. The moment your form again comes back into Q1, we are more than happy to collect you. So therefore, there is a reasonable meritocratic kind of a decision as to when a stock is bought, when a stock is held, and when a stock is sold. And this is what, like I said, was the single largest dilemma of human fund managers. Because generally what happens is, when a stock underperforms, the feeling is, oh, it has underperformed so much, maybe now it will perform. Therefore, in some sense, hope starts coming in, right? Out here, we think that emotion tends to give suboptimal decisions. If you have a reasonably meritocratic rule book, it typically makes decision making a lot more easier, and therefore you get a more repeatable outcome.
So when it's purchased, you're getting the emotions out by getting your processes done. At the same time, when you're exiting as well, you have created a process where the emotionless decisions can be taken on the quant.
Absolutely. Okay. So in some sense, we keep saying that, Indian fund managers are like Abhimanyus. Okay, we know how to get in. There is many frameworks that we can devise, when to buy a stock, when valuations come here, when that's a catalyst. You can make multiple frameworks, but the exit framework is equally important to have. And through this process, we have a very clearly defined exit. It doesn't mean that every player will perform in every match. It doesn't mean that every match will be won. That is not the endeavor. But do we have a process where more matches are likely to be won? Absolutely, yes. Okay. And therefore, if you keep following this process time and time again, the chances and the probability odds move up meaningfully for the investor to experience reasonably repeatable outcomes.
From an allocation point of view, for advisors, distributors, and even investors, where do you think this strategy will fit? Whether it will fit into the tactical strategy or a strategical strategy?
See, generally when we think about quant and all, there are a lot of misconceptions, right? That it's a black box, that we don't know how the quality of names will be, because it's just looking at some patterns and from there it is trying to identify, is it a predictive thing? How do we know the predictability of this process? And generally we've seen that through this, the volatility of the experience tends to be very, very high, and therefore most strategies end up being fringe strategies or allocations, right? Our endeavor is to demystify this entire process, which is why we've given the entire process out in the open. People will know exactly when we are buying, why we are buying, why we are selling out. So the process, therefore, which is why we give 80-90% of our process out, so that people can understand that. Secondly, by buying in a very high quality universe which is vetted by all the active managers, the chance of getting a poor quality company where something can terribly go wrong permanently is reduced dramatically, right? Thirdly, our weighing is on the basis of volatility, which means volatility is another name for consistency or long term consistency, right? And therefore you are likely not to get a hugely volatile performance. But the real reason why you need to look, or an advisor needs to look at it, is the ability to diversify, right? Now, one way of looking at that is what is called the active share. Active share is basically how much a portfolio is different from its benchmark, right? Now, out here, the real insight as to why these strategies work is not because what is being bought, okay, that of course is adding to some alpha, but what it is avoiding or what it is selling out of. And that is a significant insight, because sometimes what happens is that many fund managers, either because the benchmark has a large weight into a particular sector or a large stock, they may end up owning some of it. Now, or they could have a view that, okay, this sector will eventually do well in 1 year, 2 years, 3 years. This strategy is not trying to find a stock at its bottom. It will never be able to identify the stock at its bottom or a sector at its reversal point, etc. We will most likely miss the first 10, 15, 20%, okay, without a doubt. But what we are trying to avoid is basically that process of bottoming out. Sometimes can last 3 months, sometimes can last 3 years, sometimes can last 10 years. And in that process, when capital is allocated in the hope that something is going to bottom out, and when you keep adding that capital, that's a lot of capital which is blocked in a portfolio which isn't actually performing. Here, there is very little capital which is being blocked. That doesn't mean that everything will perform. Of course, like we said, there is a strategy. When it is not performing, it goes back, right? So, but the idea is what we are seeking to avoid is more important than what we are seeking to buy in. And that is why we are saying that this is a fund where the active share will be 80 to 90% compared to the benchmark. Most other active funds would be having an active share of 50-60%. Here, this is benchmark agnostic. This is completely bottom up. If there is a signal a stock comes, there is no compulsion that if, say, the banking sector has a 30% weight in the benchmark, we need to have some weight in the benchmark. We can be zero banking. In case there is no signal in any of the banking stocks, there will be zero banking. It can be 20% banking, it can be 0 PSU, 20% PSU. Therefore, it becomes a very fluid kind of a portfolio where you get the actual benefit of diversification compared to every other strategy, right? So, in our opinion, therefore, this is a core large and mid cap fund, okay, where the quality is reasonably very high. The weight on volatility or low volatility, so the overall volatility is also not going to be very different, and it is going to provide a diversification against all other portfolios within that same category. Therefore, we think it's a part of a core allocation rather than looking at a fringe allocation.
Okay. So, from an investment perspective, for an investor, how much time frame or how long that he should be looking at this investment?
Sure. So, what we have seen is in the near term, say in every 3 months or every 6 months, basis the back test from 2012 to 2024, 12-year data, we see that there is almost a 60% chance or evidence where this has outperformed the NSE 200. Therefore, there is a 40% evidence that it has underperformed. So, in the near term, there is a reasonable amount of time frames when this kind of underperforms. But as you hold on to 3 years, as you hold on for 5 years, we've seen almost a 95-99% evidence in the back test, wherein post cost this seems to do better than the average than the NSE 200 total returns. Therefore, one should definitely come in from a 3-year, 5-year period. Like any player or any strategy, this will not work in every match. In every match, you know, if there is an odd of 50-50 that it can succeed, here the odds are moved more closer to say 60, 65, 70%. So, the odds are there, but we can still have a case wherein India gets 36 all out, right? Even with all of these things, you will have these phases. There will be pitches which are completely different from the average thing. All we are saying is when those things happen, there will be again a review. Like in the rebalance, we have a sell strategy. In those phases, there will be a massive amount of churn. Okay, we'll get into a completely new team with the idea that they will start performing. But generally, what we have seen is in a 3-5 year period, a lot of these small patches get kind of moved over, and the longer tenure and the longer odds of winning starts coming through. So we would definitely recommend investors to at least come in with a 3 or a 5 year horizon to experience the reasonable repeatability of alpha creation that these strategies can potentially offer.
Okay. So you're also trying to say that there is a possibility of higher turnover happening in the portfolio?
Yeah. So typically, a quant related strategy has very high turnover, which is that, what happens is you've got one particular signal at one point of time. At the time of rebalance, like we said, you get another signal, and they say that entirely this thing will be sold out and this will come through. We have, like I said, a slightly different thing, wherein we are not moving out entirely from this. So compared to a pure quant wherein turnovers are as high as say 500-600%, here turnovers come down to close to about 100-120%. It is still higher than a pure active, which typically hovers around 50-60%, right? But it is much lower than the additional or the other quant strategies, which typically tend to have very, very high turnover. Because we genuinely believe that time for a well-managed company does wonders, right? And therefore, we need to give it time rather than constantly flipping them every now and then.
Cool. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.